Hello everyone, so welcome to our latest Artemis Live interview, and today I'm delighted to be joined by Patrick Roeder. He's an associate partner and the global head of ILS at consultancy firm Synpulse. Patrick, welcome.
Hello, Steve.
Good to see you. So during the third quarter of 2020, we've actually been working with Synpulse, conducting a survey looking at the maturity of environmental, social and governance adoption in the risk transfer, reinsurance and insurance-linked securities markets. It's been the first ESG survey of its kind, looking at how companies in the risk transfer value chain and investment players have incorporated ESG within their strategies and operations. And the full results have just been released, and participants in the survey will be receiving specific benchmarking of their results, so they can evaluate their own levels of ESG maturity and look at how the industry is adopting those practices and in how the competitive landscape lays out. So I thought it would be really interesting to talk with Patrick and go through some of the findings from that survey, which he and his team have been analysing in detail. So Patrick, perhaps to begin, you could just provide a bit of insight into why environmental, social and governance factors have become such a hot topic in risk transfer, and why that applies in the ILS market as well.
Yes, absolutely, Steve. So I think while the term ESG might be newer, the concepts that stand behind ESG are not new at all. In fact, I think sustainability as such is at the very heart actually, of the risk transfer market. So some players might have had a bit more narrow definition of what that means, but others have pretty early on already had a broad definition and actually also been driving the definition of sustainability as such themselves. The term ESG, as I'm sure you know, has only been born in 2005. It was first mentioned in a study called Who Cares Wins. It was following an initiative by former UN Secretary General Kofi Annan. So this is really when the story started of the term, right? And since then, the topic has gained continuously in importance. And I guess not least of all is because we have a generation shift, and millennials just have different perspective, different perceptions, and also different demands for sustainable products. Now, of course, then we also have the United Nations with initiatives such as the PSI, the PRI, the SDGs, or more recently the ISDGs, which have been playing and are still playing a crucial role in the mindset shift towards a more sustainable world. Right? And then, of course, there's the regulatory side, and let's maybe focus for now on the European Union, because my view is that this regulation is definitely at the forefront of all regulatory developments in that aspect. So we have the EU's action plan on sustainable finance, which is setting new standards and also creating additional awareness and pressure. So I think all in all, I would say, it's not like this topic has become suddenly a hot topic for the reinsurance and the ILS market, but it has built up over time. Right? I guess it's true, it's fair to say that in ILS and reinsurance, it has been a bit more recent compared to other parts of the financial industry. But that's probably just because, and that's again my view, that the asset class of ILS and the underwriting side of the insurance and reinsurance industry is just a bit more complex. When you look at the risk, the value chain, so all the parties that you have to look at, it's much more complex than analyzing an equity investment. So I think it was really just the market that needed some time to build up this pressure and also the know-how to put more focus on the topic of ESG.
Right. And of course, in ILS in particular, there's been a notion for quite a few years now that ILS cat bonds and other structures would almost automatically qualify as ESG compliant or compatible, at least, because they provide disaster risk financing and there's a definite social good there in the capital being deployed to help people. But the truth is much more nuanced than that, isn't it?
I'm very happy that you asked this question because I couldn't agree more, right? I mean, of course, I agree that ILS as an asset class and also reinsurance has inherent ESG qualities, no doubt. But that's really, in my view, just a necessary condition, but not a sufficient one. So one of my favorite examples is, if you provide an insurance policy, let's say for flood coverage, to the building of a producer of weapons of mass destruction, is that really ESG compliant? Probably not, right? So it's not only about doing good, but it's also about doing no significant harm. And to fulfill those two requirements of doing good and doing no significant harm, you really have to look at all the elements of the risk transfer value chain in the context of ESG factors, right? So you have to look at the risks, the underlying risks that are covered, the sponsors or the cedents, the collateral, all the involved service providers, maybe even where the SPV, the domicile of the SPV, where it's located in, right? So it's really a broad perspective that has to be taken here. And of course, it's not always black or white. I mean, but it's important that you go through the thought process and you think about each of these elements. And by the way, the EU taxonomy regulation, in its current form at least, because as you might know, it keeps evolving, right? It mentions non-life insurance as the only activity that is eligible under the taxonomy regulation, albeit only with respect to climate adaptation. So I think, again, this kind of shows us or speaks to the inherent, at least E qualities of the ILS market, well, at least the net cat piece of it.
Yeah.
But again, also this, sorry, Steve.
Sure, no, go on.
No, I just wanted to say that also in this taxonomy, it says very clearly, it's not only about doing good. You also have to show that your activity doesn't do any harm.
Yeah, no, that's a very interesting, very important point. And obviously, the ability to look through portfolios of risk is one of the key things that we'll perhaps discuss a little bit later, and obviously something that the industry needs to work to achieve. But let's consider the study to begin with, and perhaps you could talk us through the goals of the study itself. What were you hoping to learn from it and achieve, and what was offered back to the participants as well?
Sure. Let me maybe give you first a bit of background why we did the study in the first place. So we at Synpulse have been doing ESG projects for a while now, but on the banking side, less so on the ILS and the reinsurance side. And then, as you know, these discussions around the inherent or the allegedly inherent ESG qualities of the ILS market started popping up. This kind of caught our attention and motivated us to dig a bit deeper. So what we first did is we came up with a holistic ESG framework that would allow companies to have really, I mean, as I said, a holistic view on the topic. It's not just about saying, you know, we have this underwriting rule. I know you have to consider many aspects, like how do I train my people? What do I report? Do I measure my own footprint? So we kind of came up with this framework that helps people through this thought process. Now, the next step then was, of course, to see how applicable it is in reality and how does the market actually do it? I mean, are they following what we think they should be doing, or do they have a completely different approach? So then we teamed up with you and started this journey of the study. Now, the main goal is simple. The main goal of the study is really to understand the extent to which insurance companies, reinsurance companies, ILS fund managers, be it the dedicated ILS fund managers or non-dedicated, and also institutional investors, how do those parties incorporate ESG in their strategies and also in their operations? What did we offer back to the participants? But first of all, I hope that we could just raise some awareness generally in the market and also for each of the participants that ESG does matter and should be considered. And that's also why the study will be publicly available to anyone who is interested. Now, there's also something more tangible, and you already alluded a bit to it. I mean, each of the participants will receive an individualized analysis of their results, and also benchmark how they compare against their peer groups, and hopefully also some tips where maybe they could focus on to bring their ESG operations even to the next level.
Great, and I think that's something that market participants will really welcome at the moment, as ESG has become such a hot topic. It's obviously seen as increasingly relevant, and regulation is likely to make it even more so. But why, in your opinion, has it sort of reached this crescendo within the market in terms of the noise about ESG at this point in time?
Yeah, I guess this goes a bit back to the answer I gave to the first question, but let me try maybe to add some more flavor here. And let's maybe start with some theoretical models that were not obviously invented by myself, but I think they suit the purpose here. So it's about socioeconomic transitions, right? And they're the outcome of a buildup of innovation on the one hand, and the breakdown of existing structures on the other hand. Now, that such a transition can happen, there needs to be a lot of transformative pressure. Usually that's built up by society. But obviously this takes time, years, maybe even several decades, until enough pressure is actually here. And while this pressure is being built up, some alternatives emerge. And we already see that now in the market. I mean, we have certain ILS funds and certain reinsurance insurance companies who take ESG, or take a different perspective on ESG than maybe some of the more incumbent players, I would maybe call them, right? So once this pressure is high enough, then the old system will break down, a new system will emerge. And I'm not saying the old system disappears, of course, but the new system will be consisting of elements from the old system, but also some of these alternatives that have already developed. So bringing this now back to actually the main point of this discussion is, I think that it's just that now, the last couple of years, the societal pressure has reached a point that just makes it more and more visible, right? And I think the pressure is highest when it comes to the E in ESG, because this is something most of us can observe, right? We all read the news about these extreme weather events. Maybe some of us even have experienced these weather events. We cannot just ignore this, so we are affected by it. The S in the G is maybe a bit less obvious, but also there we can see some signs that the pressure is building up. Now, 2015 was a very important year in this build-up of this pressure, I believe. Why? Because the SDGs have been defined and also the Paris Agreement has been drafted. Right? And both of those have received widespread attention and have impacted companies, society, and also governments. Now, fast forward to almost today, right? I mean, in respect of regulation, and again, let's focus on the European Union. The response to the 2015 events was the EU's action plan on financing sustainable growth. And this action plan has different pillars, and we don't have the time now to talk about all of them. But one of them is most imminent. It's the SFDR, which comes into effect March next year, right? And this impacts all asset managers, almost all asset managers active in the European Union, whether you have an expressed ESG focus or sustainability focus or not, right? Of course, if you have one, there are further implications, but everyone has to think about this. Now, SFDR stands for Sustainable Finance Disclosure Regulation, but funny enough, it's not just about disclosure. So each of these asset managers has to think about business and business models and policy decisions, right? And how ESG impacts the business model, whether they want to care about it or not. And then they have to disclose those policies as well. So there's really a lot to be expected in the coming years, and that's why it is so relevant at the moment.
Do you feel a lot of the pressure has come in from the investor side? Because obviously, particularly in Europe, it seems investors were quite quick to link ILS and reinsurance with SDGs and things like that. Sort of back in 2016, I think that started, and perhaps that has now ramped up the sort of urgency for investment managers as well.
Yeah. So, I mean, as I said, we have also surveyed institutional investors because we wanted to get a response directly from them. Now, unfortunately, the response rate wasn't very good. So let's call it anecdotal evidence, what we have directly from the institutional investors. And there seems to be, at least for our sample, a desire for ESG. Now, when you ask the fund managers, for them, the top reason to care about ESG is indeed investor desire, closely followed by risk management considerations, but also reputation. So I guess the answer is yes, investors are also building up pressure on that front.
Yeah. And what do you think are the key drivers for embracing ESG? Maybe first on the fund and investor side, and then maybe what about insurers and reinsurers as well?
Mm-hmm. Yeah, so I mean, as I said, for the funds, it's really the top three is investor desire, risk management, and reputation. But then there was one more which was mentioned, which was positive alpha, which I find interesting because the opinions about the validity of this argument, let's say, they differ depending on who you ask.
Yeah.
Now, one thing that I'd like to point out here is that regulation was not mentioned as a top driver. I mean, it actually scored third last. And it didn't matter which region or which, didn't matter really where the player was located in which region. Even the ones that are located in EMEA said it doesn't really matter, which is interesting because, I mean, as we just heard, the SFTR is coming into force next year. Now, let's just keep in mind, we asked about relative importance, but not about absolute importance, so it might still be important. The institutional investors, they basically said it's customer demand, so they're investors that care about it. So, and I guess this ties nicely back to what we just said. You know, society is building up the pressure because ultimately, where does the money come from? You know, it's, I guess, your pension money, my pension money, and you know, we have expectation, desires. So it's kind of going through the whole investment chain. They also said reputation and equally risk management. So I guess it's fund managers and institutional investors is kind of in line when it comes to the motivation.
Yeah.
Now, you also asked about insurance and reinsurance companies. So there, we also have a risk management component. So risk selection, reputation, new business opportunities, and also altruism. So I think overall we can see that reputational considerations as well as risk management considerations across the market are very important considerations.
No, so you mentioned two very interesting things there that I'd just like to dive into slightly more. One is the lack of a mention of regulation as a driver when actually some of the regulation could really potentially impact some investment managers in particular, couldn't it? Unless they're ready. And I guess the other one is the positive alpha, which is, as you said, interesting. It's hard to understand how having an ESG strategy would deliver additional positive alpha, as in the transactions are going to be relatively similar, but just maybe for specific cedants. But I guess where it can generate more alpha in the end investor's eye is in the fact that the investment manager has taken the time to select its risks a bit more thoroughly and differently, and perhaps that delivers a different return profile as well. I don't know, have you got any thoughts about that?
Yeah, maybe I have a view on that, but probably I'm not the best person to ask this question because I don't do these investments. But I mean, I guess you have a point there. Maybe the risk management argument and the positive alpha argument are very closely related, right? I mean, of course, you can make an argument that an insurance portfolio that scores high in ESG has low risks, therefore maybe lower volatility, and therefore, as you just said, a more interesting risk return profile, right? But I would still say that the positive alpha argument is probably more valid, potentially more valid for an equity investment strategy, where you can say, you know, in the long term, just companies that today are not sustainable will disappear. You have stranded assets, therefore it's better to invest in let's call them future-proof technologies, right?
Yeah, interesting. One of the findings in sort of the results of the survey and the study is that there's a degree of overconfidence among some quarters of the marketplace, as in the companies themselves are perhaps more confident in their own ESG readiness than they really are. Why do you think that is?
Yeah, okay, let me first clarify 2 points before I answer this question. So first, and that's very important to note, we took the respondents' answers as granted. So we did not question whether they were telling us the truth, right? So if someone said we have implemented an ESG strategy and it's effective, we just take it as it is. We assume it's true. I mean, even if we wanted to, we couldn't verify whether it's true, right? So whatever we say is based on how the respondents perceive reality, right? Now, overconfidence, maybe we have to quickly define what we mean with this. So here it's kind of the overconfidence bias. So a person's tendency to be more confident in his or her abilities than maybe is objectively reasonable, right? So kind of if you ask 100 drivers whether they think they drive better or worse than the average driver, you know, 70% would say I drive better than the average. And, you know, we all know enough about mathematics that this somehow doesn't add up. By the way, if you ask women, the number is more closer to 50%. So, but anyways, the point is in our survey, now 80% of the non-dedicated ILS fund managers believe that they're ahead of their competitors when it comes to ESG. And the same was true for about 70% of the dedicated fund managers. And that's why we say there is probably some overconfidence. Now, of course, there might be alternative explanations. One could be that we compared within these peer groups, non-dedicated ILS fund managers, dedicated ILS fund managers, while maybe the respondents defined competitors more narrow. Maybe they had a different set of what they think.
Yeah.
They are direct competitors. Now, the second reason might be that someone doesn't make their ESG activities public, so competitors are just not aware what competition is doing, and therefore they think they're ahead because they have obviously more insights into what they themselves are doing. So we have to be a bit careful, but at first sight, it looks like they're overconfident. By the way, reinsurers are underconfident, so 25% said that they're ahead of the market, and insurers were exactly at 50%. So they seem to have a good view of where they really stand.
Yeah, that's very interesting. I think it may also have something to do with the resources available to different types of companies in the value chain, perhaps as well, and how much time they've had to actually implement ESG strategies. Which brings me on to sort of the next question, which what did you learn about the operational readiness of the market as a whole when it comes to ESG? And I guess could you touch on some of the different players and how operationally ready they appear to be or otherwise?
Yeah, and I think this is a main question. So, while the majority of respondents agree that ESG is important for them and they have a strategy in some sort, only 15% of all the respondents have said that they have a strategy which is actually effective, right? There's a good piece of the respondents who also said they have a strategy, but it's ineffective, and then there's also some that just don't have a strategy yet. Now, what does it mean in detail? So not all companies have yet a dedicated ESG role, for example. And here, I'm not talking about a specific person or a specific team that takes care of it, or a dedicated person or a dedicated team. It could even be one person that just has an ESG role, right? But some companies don't even have this. So it just there's no responsibility for the topic. Now, it seems that non-dedicated ILS fund managers and insurance companies are better organized in that respect. And somewhat that, at least for the non-dedicated fund managers, might not be surprising, because very often those are bigger companies that have bigger, or let's say, more resources at hand. But as we also already said, other asset classes are maybe already a bit advanced. So non-dedicated ILS fund managers in the bigger organization maybe already have some experience with ESG. We also asked about the goals, ESG goals, and a lot of respondents actually felt that the goals they set themselves are either not clear enough or that don't really make sense, right? And one finding that is very close to my heart is one that we've already touched upon. It's which elements or parties in the risk transfer value chain are you actually analyzing when you do an underwriting or investment decision? Now here, the top three were the not surprisingly, the sponsor or the cedent that is being analyzed, then the underlying risks, and then the collateral. And then there's a big gap until the next elements or parties of the risk transfer value chain come. And I think here there is a lot of room for improvement, because as I said, I truly believe that you have to analyze each element in the value chain. I'm not saying they're all equally important, but at least you have to think about all of them. And even for those top three, the percentages were somewhere between 40 and 60%. And I think this is still, this number could be higher, right? So there's a clear room for improvement there. Now, maybe if you want, we can also briefly touch about the products, ESG products that companies are offering.
Sure.
There's some interesting findings there as well. Good. And that's really a high number. So 96% of all insurance and reinsurance companies said that they do offer ESG-friendly insurance products, which is very surprising because the number of people who said they have implemented an effective ESG strategy is very low. Now, somehow doesn't go together. Now, a follow-up question was which product, which ESG-friendly product do you offer the most often? The answer was NatCat. Now, we already had the discussion, right? I mean, NatCat, of course, has has benefits for society, big benefits, but that's not the end of the story, right? You need to think, to whom are you providing this net cat coverage? Now, of course, if you take this narrow definition that net cat is per se E or ESG compliant, then of course you say we offer one, but the view has to be more differentiated in my view. On the ILS fund manager side, also a very high number, I believe about 90% said it's important that they offer an ESG service offering. So kind of an ESG compliant fund or a green fund, however you want to call it. Only 30% or 35%, I believe, do actually do so. Now, on the one hand, this number is high because if you look around, well, at least I'm not aware of many funds that actively promote this. Mm. And on the other hand, it's low, right? Because everyone says it's important, but why is it not happening? And I think we can use the same argument as we used before. Of course, if you don't have a strategy implemented yet, maybe you're not yet ready to actually offer the corresponding product, which makes complete sense, right?
Yeah, no, that's very interesting as well. Again, that sort of maybe shouts to a little bit of overconfidence perhaps in the market too, as even the idea of Nat Cat automatically qualifying as an ESG product is a little on the outlandish side, as a lot of Nat Cat is property catastrophe, so covers property risks as well, and it's not just covering a catastrophe exposure in many cases, it's covering other perils as well. While on the other side, you have products like parametric products and weather-linked products and index-based products, where sometimes they are just a pure catastrophe exposure protection. So perhaps those specific products more closely qualify under the ESG product sort of remit, I suppose.
Mm-hmm. Yeah, so I mean the third most often mentioned product when it comes to ESG friendly products was actually some kind of low income protection products. Right. And we didn't ask specifically about parametrics, but I think you can make the connection there, right? That these products specifically designed for those kind of income classes, emerging markets, definitely a good argument to be made there.
Yeah, absolutely. And the proliferation of sort of micro insurance programs around the world suggests that that's only going to increase as well. So having now completed the study, published the results, had time to consider them, what would your advice be to the market as it looks to sort of move its ESG readiness forwards, especially when thinking about the portfolio construction and risk selection question, where it's certainly not always clear what lies beneath a contract or a portfolio?
Mm-hmm. Yeah, I mean, that's obviously a key question, if not the key question, right? So I think transparency has been mentioned as a major issue by many of the respondents, and transparency is key, in the investment process. Now, how can you get this transparency that you actually need? Now, the most convenient way to get transparency would obviously be if the cedent or the sponsor produces the transparency about underlying risks, about underwriting guidelines that actually an investor or also a retrocessionaire reinsurance company needs to assess from an ESG perspective. Now, this doesn't really, this doesn't really happen in practice. I mean, there's some good signs. Some of the cedent sponsors are maybe more proactive. I mean, we know some of the examples, right? And this is a very positive sign. But still, why does it not happen more often? I see two reasons. First of all, maybe it's not always so easy to produce the information that would be needed. Now, simple examples for a retro deal, maybe the reinsurance company simply doesn't have to look through themselves to the underlying portfolio. But there might also be just a lack of willingness to share the information. Now, another way you could create transparency would be, and maybe this ties into this lack of willingness to share, is using maybe a third party with which you share the information, which then kind of in an anonymized form forwards the information to the investors. It doesn't exist yet, just some food for thought maybe. The third way, of course, and this is what happens probably in most cases, is that the fund manager or the reinsurance company has to work with the information available that is given to them, and maybe they have some way to enrich the information with some third-party sources. But it's definitely also about making approximations and assumptions. But this is never going to be perfect. Now, next to the transparency, the standardization of the data has also been mentioned as a key issue. So in fact, both transparency and standardization, and obviously they go together, right? So what would I advise the market to do is really two things. So the first one is ask, and ask. So really, just keep asking what information you would like to see in order, as a reinsurer, as an insurer, as an analyst fund manager, what information do you need to make your ESG assessment of the investment and reinsurance opportunity, right? If you do that, you will start building up the pressure that we mentioned before, which is needed for a system to flip over and fall into a new state, right? And this will obviously take time. And then the second thing, and maybe this is a bit idealistic, is that, why doesn't the market agree on a standard when it comes to the information needed to make an ESG assessment? Now, I'm fully aware that many of the standardizations initiatives in the reinsurance market have failed, but I still think it's worth a try, right? And maybe lastly, I'd just like to make a point, because sometimes I hear the argument from students, why should I share this information? I don't gain anything from it. But I don't think this might necessarily be true. We heard before that risk management is an important motivator for ESG. Now, and we alluded to that before. So if you have a portfolio with higher ESG qualities, just make it transparent, because potentially it's more interesting for investors and other insurance companies to actually cover that risk.
Yes, there's a lot to be said for transparency in the marketplace at the moment, and obviously with technology advancements as well, we would hope that we get to a stage where transparency becomes almost part of standard practice for players along the value chain. And I agree. I think there's benefits to that transparency for the cedents as well, because ultimately by disclosing their risks as clearly as possible in a standardized format, they should also open themselves up to greater competition for their programs and potentially better pricing and better execution of their risk transfer as well. So I was going to ask you if you had to pick one area for companies to focus on to further their sort of mission towards becoming fully ESG compatible, where would that be?
Yeah, so I think don't look at ESG as a thing that just has to be done because now there's some regulation. That's important, of course, but I mean, really look at it as an opportunity. And take a step back and look at ESG from a holistic perspective. Take your strategy if you already have one, look at it carefully, think how this strategy impacts the different business units you have, different processes, before you jump to any conclusions. Once you've done that, just define your ESG target operating model and only then start implementing measures. It doesn't make sense, to just think now, okay, we have to, shall we say, jump on this train of ESG, it's sexy, let's offer a product. I don't think you should do that. Really think what it means for you, right? And so take a step back, look at ESG holistically. This is, I think, what I would advise.
Yeah, and probably look at how you can embed it within your standard business practices as well, so it just becomes part of your process rather than being something that has to be added on as an added burden. It's really about the industry changing the way it works a little bit as well, I would say. So if we look ahead a year, and if we were to run this survey again, do you expect that we'd see better scores, or would that maybe just be more confidence emerging as people become more familiar with this?
No, I think definitely the scores would increase, because I mean, as I already said, the market almost uniformly agreed that ESG is important for the market, but also for their company to be successful in the future. So I mean, I think, don't remember the exact number, something like 90 or 95%, so extremely high. So there is a motivation here. And maybe for the remaining 5 or 10%, maybe at least for the ones in Europe, the SFDR will help to think about the ESG. But I definitely think overall it would increase next year.
Great. Okay, well, thank you, Patrick. I really appreciate your time today. It's been a pleasure working with you on this survey, and hopefully all of our listeners and viewers will find the results interesting, they can find the survey via the Synpulse website, or of course via Artemis. If you search for ESG, you'll find the survey results and various articles pop up. So thank you very much, Patrick. It's been great talking to you today.
Thank you, Steve. Thank you for your time.
Sure, and I hope to catch up with you soon.